Hi, I'm Mehdi Sanaji and welcome to Your Finance TV. We're joined today by Loren Smith, the president of Skyline Policy Risk Group. By way of background, Loren has been specialized in transportation policy, particularly the auto and infrastructure side. Whilst working for the US Department of Transportation, Department of Labor, as well as in the private sector as a publishing analyst on this field. Loren has since founded Skyline Policy Risk Group, a research and strategic advisory firm focused on transportation and technology policy, emphasizing freight logistics and infrastructure. You have quite the resume, Loren. Welcome to the show.
Thank you, Mehdi. Great to be here.
So obviously, a field of your specialty. Over the last couple of years, we've seen multiple disruptions in the supply chain, from technology chips to cream cheese. These disruptions have played their part in the rise in inflation, which we've all been affected by. I have a two-part question for you. Firstly, was most of this associated with black swan type events, or is there a more structural issue that is bringing cracks to the surface in the system?
Yes. I look at COVID as an accelerant on some trends that had been existing and building for some time. Freight volumes and values are going to double over the next decade. And COVID basically shifted the market of consumers towards even more home purchasing, home deliveries of groceries and everything else. With freight fulfillment shippers like Amazon doing same day delivery, people are now getting everything shipped, and it just sort of increased the stress on the supply chain, especially in COVID. The specific black swan there was, a very significant shift away from services and towards goods for consumers. And so this led to, there being a huge run on toilet paper and other, different commodities that would basically disappear from the shelves at given time. This put a huge amount of pressure on retailers, which had spent several decades moving towards the just-in-time model. And so there were those shortages, and there were long lead times for deliveries. So in 2021, the retailers, sort of reacted by saying, okay, well, just in time is great if you can depend on what your supply chains are going to be in terms of the timing. But we're going to need to, just for risk reduction, risk management, we need to increase the inventory that we have. And so all the retailers were stocking up, and that really led to the major supply chain traffic jam that we saw in the fall of 2021 with container ships being, backed up, outside of the ports, particularly Port of LA, Port of Long Beach in California. And so now we're in a situation where inventories at retailers have been built up, but global consumption is down because we're going into maybe not a recession, but sort of a near recession where consumption is down. And so you have retailers that now do have a lot of inventory, but the freight industry is really suffering right now because the retailers, like, we stocked up and we can't move the merch that we have anyway.
So, Loren, you kind of touched on the second part of my question there. I was going to ask, where do you see things now, and are they trending in the right direction? It sounds like there's a glut and things aren't necessarily trending in the right direction.
Well, I think it's the disruption has to work its way out, right? You have to sort of figure out what is the new pattern. I mean, COVID was an event. We may get another pandemic. Hopefully we'll be better prepared next time. But the COVID experience of everyone decides to stock up. Okay, now the retailers are out of merchandise. Now the retailers rebuild their inventories. Now the supply chain is backed up. All of that is sort of like it's like a snake working, a particularly large meal through the body, and so that the body of the snake sort of bulges, and then it moves through the body, and then ultimately it's out. And I think that specific disruption that happened under COVID goes through those stages, and so I think that things are generally moving in the right direction. I think that just the fact that supply chain has become a term that's sort of on everyone's lips when they're thinking about freight and transportation has been very helpful in terms of figuring out what policymakers should do on regulation to improve the efficiency of the network, what should be done in terms of infrastructure, improving infrastructure, from ports to inland ports, intermodal transportation, to make sure that the things can get where they need to go. I think that the situation generally is moving in a positive direction there. Although I do think the next year or two will still be difficult.
Okay, and that obviously brings us onto the topic of inflation, which is everyone's dinner side conversation. So we're currently waiting on the US CPI number for April, and there are concerns in the investment community that this could come in hot. The Fed's looking to slow down raising hikes, and many are already talking for cuts in the second half of the year, which I find quite staggering, but it is in there. What are your thoughts on the landscape of inflation, the current landscape of inflation versus rates, and how how you see things could play out?
Mm. Yeah, it's interesting. The market seems to be pricing in rate cuts at the end of the year. I don't see it. I think that that they're going to want to hold at this sort of elevated level. We might see a quarter point reduction over the next 12 months, 1 or 2 quarter point reductions. But I think that they're keeping it generally elevated. You mentioned the U.S. statistical reporting on the inflation number, that we should get that later this week. But the other statistical reporting that was very interesting was last Friday's U.S. jobs report. That's the number that I think would really potentially cause the Fed to back off the rates, not just no more increases, which I think we're already at. Potentially cuts in the near term would be if the U.S. job market starts to really weaken in a significant way. Right now, the U.S. job creation was 253,000, with an unemployment rate of 3.4%. Those were the numbers reported this past Friday. And so that's really strong. And so the Fed can sort of say, hey, raising rates, U.S. is still creating jobs, good to go. So that is certainly a point in favor of the Fed likely holding rates as they are, rather than considering rate cuts later in the year. Although I would note, and this you can sort of dig into it either way with the jobs report. But it was pretty notable that the previous 2 months were revised downwards. So the U.S. has been beating the job creation numbers have beaten the consensus estimates for the past year. It's kind of an amazing streak. But even as the April number came in very strong last Friday, they revised February and March downwards. And so it's a little unclear how strong job creation really is. If you're revising downward by significant amounts, it would have actually made those below expectations, both February and March. But all that aside, it doesn't look like the Fed is planning on cutting rates. But again, notwithstanding the market expectations, I think we need to keep watching those statistical numbers pretty closely. I think that inflation is probably going to stay elevated through this year.
Okay, that's interesting. So you expect an elevation still on the inflation side. So do you have any thoughts going into the April CPI number, or would you kind of just watch it for the next couple of months and just see how the trend starts performing versus any particular month at a time?
Yeah, I mean, my general view is that we'll, over the course for 2023, it'll probably be at or above 4% for the full year. I think probably this week's number will be in the five range. It's with the jobs numbers staying strong, with wage growth strong, probably pushes that inflation number up a little bit, so it'll be maybe more at the higher end. But what's interesting over the past 2 years, Mehdi, we've been seeing different sectors be sort of responsible. Like who's responsible this month, or which sector? Is it airline travel? Is it used cars? Is it home mortgage? What's sort of pushing the inflation number up? Almost like they're taking turns. The different commodities are taking turns in pushing that number up. Like, oh, gas prices are down this month. Yeah, but food's way up. So I think it'll be interesting to see where the culprits are this month. But again, I don't expect a major drop in the number. I don't see why we would expect a number other than that over the next year. Hopefully, it'll fade back down to that below that 3% level.
And before I let you go, Loren, do you think that the Fed's going to have to abandon their 2% goal?
Yeah, I mean, I think that the Fed has come under a lot of pressure. And if you just look at the numbers, I mean, they did it, 75 basis points, 75 basis points, and then they've now sort of tapered down to this 25% basis point. When I think if we see another surge, probably we would see another rate increase potentially. If inflation sort of goes back up, crosses over that 6% number. But I think that I think bar that, I think that Fed probably is sort of stepping away from it a little bit, or they're certainly not, enforcing it in a very, in a very strict way right now, just because I think there was a lot of concern that whatever is happening with the U.S. economy, and again, it's a little bit of a Rorschach test. We're certainly walking on the line of having a recession in the second half of the year.
Understood. Loren, thank you so much for sharing your thoughts from Skyline Policy Risk Advisors. I really appreciate you taking the time.
Thanks, Maddie.
I'd like to encourage our viewers to access your content as well. Go to skylinepolicy.com and sign up. And also, don't forget to like and subscribe to Your Finance TV. Stay on top of our content. Until next time, thanks for watching and good luck investing.